Marianne Amiot, Chief UK Economist at S&P Global Ratings, good morning. The Bank of England is holding its next monetary policy meeting this Thursday. It cut interest rates at its last meeting, but what can we expect this week?
Well, thanks for having me. So I would say, in short, we expect no rate cuts. At the moment, it's a bit of a tricky time for the Bank of England. So we've seen that inflation has fallen like everywhere else, but the strength of the wage growth profile has been quite surprising if you look at the weakness of the economy at the same time. So it points to, I would say, an underlying weakness in the country's ability to grow, and that makes it harder for the Bank of England to understand whether the inflationary pressures are linked just to the past shocks we've seen, or whether this is linked to I guess, a smaller capacity to grow of the economy. So in my view, the Bank of England will be very cautious this year and probably be careful about not seeing more inflationary second round effect of the renewed pressures from energy and food prices, but at the same time, watching that the labor market doesn't cool too fast. So in my view, we might see 2 more rate cuts this year, but definitely not this week.
And a risk that the Bank of England will be watching is US President Donald Trump, and in particular his trade policies. But how dangerous could a trade war actually be for the UK?
So on the face of it, I would say the UK is not too exposed to tariffs from the US on UK goods, because if we look at the 10% tariff, for example, as a ballpark number, this would cost about 0.2 percentage points to growth in the UK. So it's not such a big number. But I think in the short term, what the tariff war does is raise uncertainty. So the UK might even get a special agreement with the US, but for companies, it's really hard to get clarity on this in the short and medium term. So this will weigh on their investment ability. Another thing that matters as well, I think, for the UK is uncertainty for consumers. So they've not spent as much as they would have in the past because of uncertainty about the economic outlook. And having more uncertainty from abroad, I think, does this raises the risk that they continue to be quite cautious. So overall, definitely a negative impact on economic activity. It might not be a short-term recession, but at least it will weigh on the growth profile.
And UK Chancellor Rachel Reeves will soon deliver her spring statement to the House of Commons, outlining her spending plans. But do you think that she will stick to her own rules on borrowing at a time when there are so many critical demands on the government?
It's a good question. So it's a bit of a balancing act, I would say, for the government right now. So as they've highlighted in October, they want to spend more on public services, but obviously you have to meet that with some higher taxes or less spending elsewhere if you abide by borrowing rules. And the equation has changed slightly since October because borrowing costs are up about, I think, 60 basis points. So that really reduced the headroom for the government. I would say that there's been a lot of signaling in the past few weeks that spending cuts are coming, at least in the welfare system. I would say it's not just about a borrowing rule story, because the market is also asking if any more spending can really boost growth. We've not really seen that in the past few weeks or months. Adding to that, over the past 2 years, if you look at the GDP profile, all of the growth almost has come from the public sector, but yet we see productivity stagnant. And if all of the growth has come from the public sector, it means the multiplier, if you will, for the private sector is very low. So I think it's fair to ask if there is some way the public sector can be more efficient. So it's not just about self-imposed borrowing rules, but also a general story about the economic productivity, I would say.
Marianne Amiot, thank you for joining us.
Thank you.